Elizabeth was just saying, search best looking people at the party. In what context was
Out
that?
of context.
She's talking about a picture of the three of us, actually.
Well, I didn't bring it up. Dan
Okay.
said I had to find the picture of the three of us from my wedding reception.
Yeah.
And I said, there
Well,
are
how are you gonna-
thousands of pictures.
I was going to say,
It's
there
gonna
are
take
thousands
me a
of
while
pictures.
to find that one. So then I made a joke. I'll just do a search for best looking
Yeah.
people at the party.
Oh, is that how that works?
And I figured it would just pop up.
So I don't.
Are we recording right
Yeah,
now?
no,
Oh,
we're alive.
already?
Amanda,
Okay.
I'm not. I don't have my IFB in, so
Yeah.
Amanda can be yelling at me. I wouldn't know.
She could do.
I'm sure she's upset.
This is the market call.
It's July 10th.
Yeah.
What time is it?
It's 1 o'clock.
When did you get your
1:01.
haircut?
I just got it a little bit ago.
That's a
It was
nice
pretty-
haircut.
Pretty dope.
Right?
Yeah.
I mean, I think it looks.
We got
shorter,
Liz.
but
Liz
the
has
same
not
as
been in the
always.
studio.
No, we had the
with
three of us
in a
haven't
bit.
been together
Just
since
the
her
three
wedding.
of us.
Yeah.
Yeah.
By the way, again, congratulations.
Yeah.
Thank you.
Beautiful
Thank
event.
you.
No, I mean that.
Yeah.
Thank you.
And it was as probably the nicest day
It was.
/ evening
Oh yeah.
We
of
got
the
so lucky.
frickin' year.
Yeah.
It was
Yeah. It was
spectacular.
like 79, 80, dry, sunny. It was
Yeah.
perfect.
It was
the
perfect.
perfect
and you
temperature.
deserved that. And we talked
did
about it
deserve that.
at the time.
Yeah.
How are
It-
you,
it
by
was
the way?
perfect. I kept saying it's great because the women aren't cold and the men aren't hot.
Yeah.
Yeah.
Well, there were
Great.
some hot men there.
Well, hey, that's up to your opinion.
And how about those bridesmaids?
I thought
I'm
the
just
groom
kidding.
was pretty hot.
Hundo.
There it is.
I hope you
Should
would
we get
think
to
that.
this? Because they
Okay,
say,
it's
they
1
say-
o'clock
they
on the
say
East
we lose
Coast.
people.
Guy, we don't. Nobody's leaving.
We
It's
just got
Guy,
here.
Elizabeth, it's Dan.
Yeah.
It's 1 o'clock on the East Coast. So let's just throw the rundown up behind me. Watch this.
Bang.
Look at that.
That's pretty
God.
cool.
I'm
Well,
in a new seat.
This is a
weird.
question. Will the CPI report spark volatility? We're going to attempt to answer. Valuations to infinity and beyond. Isn't that like Toy Story?
Yeah, exactly.
That's that guy,
That's
right?
exactly
Buzz
that.
Lightyear.
Yeah.
Software options trade.
Yeah. IGV. We talked a little
Because
bit.
those suckers have been getting woodshedded.
I think on a relative basis, and we're going to talk about that a little bit, but I think heading into earnings season, I think you want to lean on software a little bit, Guy.
Well, we're going to talk about
Yeah.
it. And it's Wednesday, so we'll do a little audience Q&A.
Oh,
Now, Elizabeth said it's hotter than the surface of the sun,
Yeah.
but you still have your jacket and tie on. Yes, I do.
I don't understand it. Like we're in air conditioning now, but he showed up, viewers, in his tie
Yeah.
and his jacket and dress pants from outside,
Yeah.
which is literally hotter than
It's
the face
warm.
of the sun today.
And I'll go home the same way. I'm not one of the, as you know. By the way, I don't know if you saw this, but there's this new thing apparently that I started on planes. What's it called?
Oh yeah,
You saw that, right?
They're using the name wrong, by the way.
they're not using the right word.
Yeah.
Yeah.
We're not
But
even.
that-
Something about I don't know if it's Gen Z. There's
Yeah.
a much younger
You're
generation
definitely not Gen
that
Z,
has
by the way.
decided that they're going to punish themselves on planes
Right.
for whatever reason.
How many times have I talked
and,
about that?
and just sit
A
and
lot.
look straight forward and not do anything of entertainment value whatsoever.
Right.
I don't understand the purpose, nor do I understand why you do it. I don't know what they're.
I've been doing it
after
for my
either,
whole
but
life. Now apparently it's a thing. I
Copycats.
guarantee, and we're going to get into the market. I guarantee somebody saw me doing it and like, this looks pretty damn cool. I'm going to copy that maniac
I think maybe
because it is a little psychotic.
Yeah, I don't know if that's what
All right,
happened.
well,
but
we'll see. Let's talk about things because the first thing we want to look at is J.P. Morgan's trading desk,
Yeah,
Dan,
Yeah.
is warning that CPI might see some volatility on the back of it. I don't know what to tell you. They've given us all these sort of probability things. CPI comes in at X. What's going to happen to the market? I mean, that's not particularly helpful.
Yeah.
Unless, you just want to sort of gauge what's
Well,
going on.
let's
here we are.
Let's take the meat of this, Liz. Okay.
Mhm.
So between, you see 0.15 to 0.2, right?
Mhm,
That's about
mhm.
a 35% probability. That's month over month reading.
Okay.
Okay. And then if you look at 0.2 to 0.25, that's 30%. So you see where we are right there. That's where people think it's going to be. And then if the S&P 500 reaction would be, up basically 50 basis points to up 1% if it's on the lower bound that we just talked about, and then up 0.25% to 0.75%. Okay, like whatever. I mean, what are we gonna do? We're gonna trade off that, to your point, Guy. Your main man Mario, put some data together, not just the S&P.
I'll take Mario over.
I know you will.
No, I will. I'm
but
just saying.
Amanda calls him Mario, or
I
Liz
call
does.
him Mario.
Liz,
He told
walk
me
us
to call
through
him
this
Mario.
data that you guys put together. Give us a sense of how you think positioning is into the CPI print, and then let's talk about like some of the volatility we've seen in and around S&P 500 and yields over the course of this year.
Yeah. Okay. So first of all, obviously CPI days have been big volatility generators, both on the upside and the downside. We put a chart in even the mid-year outlook to talk about the market rewarding and cheering for cooler data. You're seeing a lot of that data here too. This is actually a little snippet of that same chart. So if you look at the table on the upper left-hand side of this page, the day of a CPI report, so this is going to happen tomorrow at 8:30 a.m. Eastern time. If we get hot CPI that day, the S&P has been down on average about 0.8%. If we get cold CPI, S&P has been up on average about 1.1%. So a couple takeaways from that. The market is still cheering cooler data. Also important to note, the market is cheering cooler data more than they're punishing hotter data. So I still think that will continue, especially because we're still above target and because people are still clamoring for this September cut. I think CPI tomorrow has the potential to absolutely lock in a September cut in the futures market. We're at what, 74% today, 75%. I think we get in the 80s, if not above 90 pretty quickly if it comes in cool.
May I ask you a question?
Sure.
I recall it's probably a year and a half or so ago, and you know me, as none bright as I am, I remember everything.
Yeah.
And you said there was going to be a point in time where the Federal Reserve moved the goalposts in the form of that 2% target. And you said the market will probably champion that on that particular day, but then they'll come to the realization that, wait a second, maybe that's not the best thing in the world. Did that happen today? Because I've read and heard some things that Jerome Powell's basically saying we don't need to get to target in order to start cutting rates. Was that what you sort of thought would, when you made that comment however many months ago, is that what you envisioned?
So it didn't happen today for the first time. He's been saying that for, I would say, a couple months.
Seemingly, yes, but it's something.
It's stuck today.
Yeah, it seemed to. Yes, it's stuck today.
So I also want to be clear because there was a lot of narrative around they're going to change the target. I didn't think they were going to change the target because if they change the target, I thought it would work against them. They'd have to admit that they don't have the tools to get it to target, but they would have to at some point cool off this really hard stance and say, we will be satisfied with something slightly above target because it's just not going to happen as quickly as we thought, which is now what has happened. And he basically has said, we don't have to wait for it to get to 2 to start cutting, but I think he will still reiterate, we will get to 2. So starting cutting at this point, what I view September as, if they start in September, is simply a message that they're done hiking. They're going to cut by 25 bips, and it's a message, we're not going to hike again. We take that off the table. But then what we know now about the unemployment rate, about the labor market cooling, he's happy with the balance now. That's what he said yesterday. Happy with the balanced labor market now. But as we've talked about many times, and Guy, I know you share this sentiment with me, now we're at 4.1% unemployment. It's moved up for 3 months in a row. If it continues to move up, I think I said this last week, it hits escape velocity pretty quickly. So now they're at this point where they're hoping that it turns out a soft landing. It doesn't hit escape velocity and rise quickly. But if as the year goes on, let's say they do 25 in September, labor market cools to an uncomfortable level, I bet we get a 50 before the end of the year.
Dan wants to get in. I have one more question and I'll stop, I promise. Are you of the belief that rate cuts will stem the tide in the employment picture? I want to put it out there. I am not. I think once this thing is in motion, that being unemployment going higher, I think it remains in motion for a period of time regardless. What are your thoughts on that?
I don't think it will stem anything in the labor market. I think that we will start to focus on the labor market much more than we're focusing on CPI for the second half of the year, but because the labor market is cooling. And I'll remind people again, any comparison to the mid 90s when they cut rates and they seemingly pulled off a soft landing, they were cutting rates into a strengthening labor market, a tightening labor market. The unemployment rate was at 5.6% and falling. This would be the Fed cutting rates into in a cooling labor market, a weakening labor market. And I think that there will be a short period of time, if it all happens as we expect, there will be a short period of time where we know they're going to cut. They do it. They say, we're pretty satisfied with the way CPI is going. We're going to get 2 more readings after tomorrow before they even do that cut. There's going to be this like little euphoric period of, oh my gosh, we did it. And then if things continue to cool, that's where the concern is. There are a couple variables that I think need to stay at a certain level. First of all, the SOM rule, I won't spend too much time on, but it hasn't triggered yet. It's getting there. It's getting close. And GDP, I think, has to stay at or above 2% in order to forgive a cooling labor market. So I think the focus ends up being on growth over CPI.
Right. And so, the one thing I would just say is that, to your point, Fed Chair Powell has been signaling this, right? They're not going to wait until they get to their 2% target. Some of us thought that they might move the goalposts on the actual target, right? Somewhat earlier, especially as, inflation was a little stubborn. It was a little, what do you call it, Guy?
Persistent, pesky.
Yeah. It does seem like, as, employment, unemployment goes up a little bit, right? And we see a softening of the economy in general. It makes sense that you would see, a little bit of a floor on inflation at some point, right? Like, I don't know. I mean, I just can't see it going too much lower at some point, especially as they start to lower interest rates. And Guy has obviously been on the train that if they start cutting aggressively, it might reignite inflation in certain parts of, the economy and such. So again, the Fed's focus has been not letting this get entrenched, this inflation in the economy, right? And they don't want one of those kind of, what do they call it? Like some sort of spiral, wage spiral. Yeah, that sort of thing. So again, I think it's clear as mud, but let's just look at the S&P. It's up nearly 18% of the year, right? The NASDAQ 100 is up nearly 23% of the year. The composite is up about 24% of the year. So stocks don't care about any of it, right? Like, so we've had this restrictive rate at the upper band at 5.5% on the Fed funds. And normally you would think that's not good for stocks. That's not good for valuations and the like. They just don't care. Look at the 10-year U.S. Treasury yield. It's been in that downtrend. Again, if it gets down to the lower end of that trend, you're talking about 4.1% or so. And maybe that's what basically equity traders are focused on there, Liz.
Yeah, I mean, the 10-year yield has been an interesting thing to watch. It's obviously been choppy, but in a downward motion. I still am suspicious about what will happen if we get closer to uninverting in the yield curve. I think it would require the 10-year to stay at least where it is, maybe go up a little bit if we get some hotter economic data. But this is a tough time for the Fed, and this is a tough time for markets. We're not at these super extreme levels, but some of the metrics are starting to look pretty concerning. So if you look at things like the S&P 500 forward PE ratio in the 86th percentile over history, even the trailing PE ratio, we'll talk about that later in terms of buckets of CPI ranges, that's pretty extended as well. And then things like the spread between the market cap weighted S&P and the equal weighted S&P is about 17% over a 1-year basis. That is the 99th percentile of a spread. So the fact that we are that concentrated in large cap names is very extreme. And then the last one that we've talked about before is that if we remain this year at a place where the max drawdown has only been 5%, that's the 91st percentile, meaning one of the lowest ever that we'll have. So we're at those extremes. Now, does that mean we need this huge pullback? We need a catastrophe? No, but I would phrase it as we probably at some point need a redistribution of strength among sectors. We probably at some point need a normalization in those PE ratios that are so extended.
Those are superlatives that we haven't seen in a while. And I'll say this, you talk about the re-steepening. If it happens, it's probably going to happen, as you just sort of alluded to, with 2-year yields coming down probably to like 4.25, 4.3, with 10-year yields sticking right where we are. And there's where you get your flattening. And, I don't know if the market will like that, not like that. I have no idea whatsoever. Or maybe it could take place with, these 10-year yields sort of creeping back up and meeting somewhere in the middle being 4.5%. So that's something I'm obviously watching as well, Dan.
Yeah. So you put some visuals here for the valuation stuff here, Liz. Maybe we can kind of work through that. That's going to be in your weekly, I suspect, that drops tomorrow. And by the way, if you want to get that weekly in your email box, there it is. SoFi.com/ on-the-money. Really? That's what we're doing? Yep. That's what we did here?
By the way, I saw Noto on the one of those shows this morning.
Your boss. He was on the Squawk and Friends. I think with Julia Borstein.
Out there in like
Idaho
or Utah.
Something like that. Very early. All right, so let's walk us through this a little bit, because Guy and I have been talking a little bit about the multiple expansion that you've seen in some of these largest, tech names, which are driving some major performance, as you just mentioned, in the broad indices. And I'll just say this, you talked about that spread between the equal weight and the S&P, market cap weight, which we just said is up nearly 18% versus only 4% in the equal weight S&P.
So it's not down. That's a good thing. But the spread, there's a lot of FOMO happening in that spread. So this week's column is titled, and somebody tell me who the band is that
Let's
sings
hear
this song. Can you take me higher?
That's it's like Night Ranger or
No.
something.
Well, you're
hold-
thinking of Can You Take Me High Enough?
April Wine. No, I don't know.
There's a song, Can You Take Me High Enough? That would be by the Damn Yankees.
Damn Yankees.
But
Look at you.
This is a lyric from a Creed song.
Oh, yeah.
Excuse
That's
me?
just called Higher.
Late 90s.
Creed?
It's
Can
a
You
horrible
Take Me
song.
Higher? I
Aren't they
knew
like
you wouldn't
Christian
know it.
rockers?
I
think
have
they
no
are.
idea.
By
And
the way,
opening-
Night Ranger was
Yeah.
one of those bands they put together. It's Ted Nugent was in that
Yeah.
band, and a guy
was like
named
a super-
Jack Blade, I think that was his name, in that band as well.
Yeah.
And they sang a couple songs on that album. Was an old guy sitting out of a pickup truck with a beard. That
Okay.
was the album cover. I don't know if we can put it up on the fly here, but
Hopefully
anyway,
not.
please continue.
No idea. Anyway, so whether you like Creed or not, this song is very good for this column. So, Can You Take Me Higher? What we did is we took a look at valuations. And the reason that I got concerned about this, or at least curious about it, is because we keep hearing these arguments that, yeah, tech has had this really fast run. The market is up a lot, but things still aren't that expensive. So I wanted to understand what that argument is and why people are saying it. So we've looked at this a couple different ways. This is the most straightforward way. We talk about PEs all the time. I still looked at this chart and said, I don't understand it. It still looks expensive to me. So these blue bars, these are relative to the sector itself. So it's like materials relative to the materials sector. Okay. These are percentile ranks for their forward PE ratios. I think everybody looking at this can tell that most of the blue bars are very high. They're very tall. Okay. So we've got the broad S&P at an 86th percentile of historical valuations. We've got Infotech as the highest over there on the left, 89th percentile of historic valuations. Financials actually next, but consumer discretionary still up there. Industrials up there. Point being here, we've got 9 of 11 sectors above the 70th percentile. So things are at least frothy. And then you look at the valuations relative to the S&P, that's the magenta bar, and tech particularly overvalued, or at least more highly valued, even relative to the broad index. So we pull this chart up and say, I still don't get it. Things still look expensive to me. Go on to the next chart. This is where the crux of the opposite argument lies. So what we're looking at here is, okay, I think really the question ends up being, yes, things are expensive, but look at the growth they can produce. So the navy blue bars here are the absolute levels of growth that are expected, earnings growth that are expected by sector. And you'll notice again, information technology is the first one on the left-hand side. So it's got the highest expected earnings growth rate over the next 5 years. There's an averaging formula in there, but 19% expected earnings growth rate. So then people are saying, so you know what? Compared to the rest of the sectors in the S&P broadly, which is only at 14%, tech is going to out-earn. That's the expectation. So I'll pay more for that. Did you have a question?
No, I would just say those first three columns there, they're basically all tech. Consumer discretionary
Right.
is Amazon and Tesla, right? So communications, we know the names in there. Infotech, that's all the software, that's the AI, that's the semis, and all that sort of stuff. So
Yep.
but when I look over towards the right, Liz, I see some different things.
You do.
Yeah.
Well, so then if we look at the lighter blue bars,
Mhm.
that's the PEG ratio. That's
Yep.
the price to earnings growth ratio. So how much are you paying
Mhm.
for that earnings growth? And this is why I think people are saying tech and communications are not that expensive, because you look at the PEG ratio compared to its own history,
Mhm.
only in the 73rd percentile for tech, in the 13th percentile for communication. So that's why I think you get that argument. And then move down the chart, and there are some really standout strange ones, right? You've got something like healthcare producing all of this growth in the 1 percentile of PEG ratios. So that would tell you that healthcare is really affordable right now, but also producing more growth than it normally does. Go all the way to the end, and you've got energy producing very little growth and at the top of its PEG ratio range. So that would appear that it's not a good place to be. I actually think it's a good place to be right now.
Every once in a while, I take these Mensa tests, like if I'm in the bathroom or something, just to sort of kill
While
time.
you're brushing your teeth.
Where
No.
do you find those in the bathroom?
On your phone.
Oh,
You could take them on your phone.
could
This
you
is
send me one of
This
those?
is
I
one
will-
reason why I never touch his phone.
Yeah.
Yeah.
Right. Thanks for
Well,
sharing.
I mean, I don't even know what that means.
Okay,
I'm
go-
not.
go ahead.
I don't understand. It's
Go
like
ahead.
my phone.
Go ahead.
Anyhow,
Anyway,
and every once in a while, there's like a question that I look at, and like, there's no effing way I'm going to be able to get the answer to this. So I move on. It reminds me of this next slide: S&P 500 trailing
right.
PEs
Yeah, this is
by
it.
CPI range. So I'm not going to try to figure out what this means, but I know you're going to explain it to
Okay.
us.
So the first couple charts, the first chart, I was like, no, the market's still expensive. The second chart, I was like, okay, I guess I understand the argument on the other side. If you want to really pound the table on it, fine. Then you look at this chart. This is where we bring the macro in. We did this because obviously CPI is going to report tomorrow. If you look at CPI by ranges, this is headline CPI. So we put it in 1% buckets. And we've got 1 to 2%, 2 to 3%, 3 to 4%. So right now we're sitting at 3.3% for May. The expectations for June are 3.1%. We don't know this at the time of this writing, but look at these buckets. And this is these gray shaded areas are the 25th percentile to the 75th percentile. So pretty well represented in a range. Median PE, median trailing PE in this CPI bucket is 17.8 times. We are currently at 28.1 times. We are more than 10 turns above that. We are even far above the top of this range. So one of the things I was trying to find the silver lining here. Well, okay, if CPI falls, here's the good news. The median PE goes up. If it falls down to that 2 to 3% bucket, median PE goes up to 18.2. Bad news, we're still at 28.1. So still 10 turns above that. This chart, this is what would keep me up at night. This is why I can't get on the bandwagon of, oh, things aren't that expensive. I think things are quite expensive.
Then let me ask you a question. I'm sure, yes. And I actually did understand what you were looking at, but I like to play dumb because it's easy for me. But with all that said, I mean, that is extraordinary where we are. Nobody cares about it. And you would be the first one to say as well, valuation is not a timing mechanism. But if you look even at forward P, you know what, and FactSet just had a thing on this recently. We are surpassed the 5-year average and the 10-year average in a very meaningful way. I guess my open-ended question that there is zero answer to, ET, is why does nobody care right now? Like what are they? Because if you throw the Buffett indicator out there as well, also that's at levels I don't think we've ever seen before. So enlighten me.
I mean, I wish I had a great answer to that. I think part of it is there's been a FOMO trade. Part of it is that we've had this rotation back into, I mean, we've seen this story multiple times through this cycle. It's like, it's a tale as old as time at this point. We had the broadening out again, and then we had this rotation back into those same big names. And here we are, they're driving the market. And now we're getting these indicators of it being overly concentrated again. Even the percentile ranks, I wrote it in the piece. I said, okay, so if you want to make a counter argument to this, you could say, well, none of them are above the 90th percentile, so there's still room to go. And that's probably true, right? They're not entirely extreme yet, but they're high. And it's really difficult to argue that they're not.
Well, this is a good segue to this call out of Bank of America. So they downgrade from a buy Visa and MasterCard. So these are two companies that have always traded at a high multiple, okay, on a PE basis, but also on a PE to growth. And, you know, I was just looking at both of these things. So on MasterCard, it is basically, and this was not a valuation call, they're talking about limited upside. These stocks have sold off 10% for Visa and 12% for MasterCard. So the fact that you're getting a downgrade here through the 200-day moving average, and this thing has not confirmed any of the highs in the S&P 500, especially as we have, you know, some of these money center banks, and again, very different, but some of them have, you know, some processing and that sort of thing, and links to both Visa and MasterCard. And these two stocks can't get out of their own way. And I just want to mention this. So if you look at MasterCard, expected to grow earnings this year, trading at 30 times. So you can do the math on a PE to growth, right? And then Visa is a little less, I think 13% expected earnings growth and about trading 26 or so times. But again, very expensive. You know what I mean? And look at how badly they act. No credit risk here. So
well, that's what I was going to say. They've always been expensive. And we've actually been talking about this a number of different times since March, like, well, maybe April, and saying there's something going on with MasterCard and Visa here. And to your point, it's not a credit thing because they don't take credit risk, but are transactions slowing? And I think that's the question you have to ask yourself, which is going to take us to this next slide. And this is an account you should follow, the Kobayashi letter. My God, I am thinking it. I want to say Kobayashi, but it's not. Anyhow, this talks about the construction industry. And I know you've talked about this many times over the last few years where construction leads. And what they're saying is, there's something going on here, folks. It's not manifesting itself necessarily in the employment picture, although we have seen an uptick. This should be concerning a lot of people. And I mentioned it on the back of MasterCard and Visa because, again, MasterCard and Visa might be seeing it in terms of the stocks, but now we're seeing it in terms of the construction industry, Elizabeth.
Yep. So first of all, financials start to report this week. We're going to hear from some of the big banks on Friday. Not to say that the big banks aren't important. They're very important. If we do see a peaceful yield curve steepening, I think banks will do just fine during that steepening environment, if not outperform because of the steepening environment, at least initially. But my most interesting thing to watch in financials is the credit card companies, because we started to hear about consumers pulling back, making different decisions, being more discerning about what they're spending on. If that needs confirmation, we are going to get it from credit card companies about the activity and about what's going on. So I think we have to listen up really closely to those. On to the construction employment. There was a question, I don't remember when this was, a couple months ago. We had a question on one of these days. I think it was just you and me here. Somebody asked, ask Liz if there's a leading indicator for recession.
That's why I brought it up. And you talked about that.
And I said construction employment.
Yes.
Because construction employment leads the broader labor market by, I believe, 6 to 9 months. So if you start to see a pullback in construction employment, or in this case, an increase in layoffs in construction workers, you should expect that to trickle into the broader labor market, but it takes a while. That's why labor is such a lagging indicator. We find out about it much afterwards. And even the concerning indicators like continuing jobless claims, it's not a continuing claim until it's been continuing for a while. So we find out about it much later than it actually starts happening.
Hold on. Before you say, I want to say one thing. So you talked about that being a leading indicator. And I'll say one other thing. Another leading indicator is the unemployment rate in the state of California, which, if it was its own economy, would be the 5th largest one in the world. And I think the unemployment rate in California is north of 5.1%. So again, people will make up reasons why it doesn't matter this time. Historically, it always matters. California leads the broader economy by the same amount of time that you just indicated for construction. Go ahead, Dan. Sorry.
Yeah, so I just want to go back to the credit card processing companies, right? And I want to take a look at American Express, if they can pull that up. So American Express is up 26% on the year. It's 19% above its 200-day moving average. We just talked about MasterCard and Visa going through its 200-day moving average. It was trading at an all-time high in late May or so. So when you think about this one, though, so you have this outperformance on a relative basis. We know that they have credit risk, right? And some of the things that they've said around credit risk, a little cautious and but the stock hasn't really cared. So let's just talk about on a PE to growth. This stock trades 18 times earnings, expected to grow those earnings 16% this year, trades at 16 times next year versus 14% expected earnings. So when you think about the disparity in valuation and performance, you know what I mean? Like, something doesn't make a whole heck of a lot of sense here if you want to compare this to the processors, but it's very cheap. I also want to go really quickly back to some of the things you were talking about on valuation. Our good friend Doug Cass sent us a very interesting little graph here, S&P 500 valuation, the current percentile ranking relative to history. Look at what's going on here. I mean, So on an EV to sales, look where we are on the Shiller Cape, right? Look on price to book,
like a weather chart.
It's crazy. You know what I mean?
Folks.
So again, I mean, like, these are the sort of things they can't go off that chart. You know what I mean? Like, you can only go to 100, right? So, guys, I know you like to bring it to 11 every once in a while.
Actually, and I talked about this in the piece too. You could go above, but it's setting new records, right? And that's what it would be.
Well, Elizabeth's never seen Spinal Tap, so that just went right over her head.
No,
but this one goes to 11. And anecdotally, and I might have told this story before, I'm in college and we're watching the Spinal Tap. It's actually called This Is Spinal Tap. That's the name of the movie. It's genius. Every time I see it, I laugh because and the soundtrack is kick-ass. I mean, Sex Farm Woman, one of the great songs written in the history of mankind.
Never heard of it.
I know you haven't. But I was watching it, and my, at the time, girlfriend was in, and she, within 20 minutes, she was bored by it and she left the room.
Yeah.
Now you're saying, well, why do you bring that up? That was a sign.
That she's not the one.
Exactly. I should have known right there. No, it's like something out of Diner. Anyway, please, Dan, continue.
Diner. You were around.
By the way, was Amanda able to get the pic? Amanda, I sent it to you. So if you can put that picture of the album cover of Damn Yankees up. Look at that.
My God.
So I was spot on, right? I said it's an old guy with a beard sticking out of a pickup truck.
Jeez.
That was from memory. Anyway,
It's a good-looking truck.
So we're talking about weakness in housing. We're talking about weakness in construction, a whole host of other areas. It looks like retail, at least like some of the consumer discretionary. We've talked a lot about Lululemon, Nike, Starbucks, even McDonald's on the lower end, how poorly they act. They're all at 52-week lows or making new ones every day. Maybe they can pull up Deere for a second. This one made a new 52-week low yesterday. So again, that might be somewhat attached to some of the stuff that we're talking about. But on the other side of this, oh, look at that. That's nasty. On the other side of this, the semis, they keep going, guys. Taiwan semi
Taiwan
overnight.
semi chart up.
Yeah.
I mean, it's,
So look what we got going on here. You saw better than expected sales here. We get what's going on. They make 85%, I think, of the world's, they produce of the world's high-end GPUs. We know where that's coming from largely. It's NVIDIA. So these two stocks are going off the page here, upper right. Talk to me a little bit about this, guys. We head into earnings. Taiwan Semi always comes out with sales prior to, we get into this cycle for semis. I just think it's becoming an increasingly horrible setup.
What happens is one company says something, they all rally on that piece of news, and the next company says something, and it all seemingly, it's just sort of building upon itself. Like whoever says something that's incrementally bullish, the entire space gets dragged up. And I don't know if that should be happening or not should be happening, but we had Roger McNamee the other day. I think you and I talked about it on OK Computer real quick. I mean, he basically said people are getting way ahead of themselves in terms of the monetization of AI. And he said a lot of people are going to be disappointed. And David Faber had a conversation with him. I think that's what it came out. And David pointed out that, a lot of same arguments you're making now could be made around the internet in 97 and 98. We'll see. I'm sort of in the Roger McNamee camp. I understand the spend that's going on, but I don't understand the monetization on the back end of it. And I think that's what's going to disappoint some people.
Yeah. And just to highlight this, so on a 1 year, we're getting kind of towards that top end of that channel. It's been a beautiful ride here, but look at the 5-year chart, guy. You mentioned this a lot, that double top that we had 2021, 2022, and look at the volatility as it got in and around that kind of breakout level. I mean, it could have been a massive fake out, breaking above it, and we sold off after that. But look at the move that we've had from 125, up until current levels here. What is it, 195 or something like that? So it's been an absolute freight train. But I guess the one thing I'd say is $190, actually $190. It's getting increasingly concentrated. And I want Amanda to throw up, I think we did this on Monday, and Liz, maybe you have something to say about this, but look at the relative outperformance of semis to enterprise software. It's just getting a bit stark here. So look at that, right? So, on some days with a whole semiconductor sector, like looking at the top holdings, the SMH versus the IGV, it's all green on the top and it's a lot of red on the bottom. Talk about this relationship.
Well, so I have talked about this many times on these programs. And again, just to remind everybody, this is one of those pairs that I chart a lot just to watch for cyclical signals. When semis are outperforming software, it's more of a cyclical signal. And just thinking about that logically, software tends to be more sticky revenue. Companies invest in enterprise software, and then they have contracts that last a long time, where semis are more sensitive to that discretionary spending. So there was a hot minute for 2 weeks where software did really well. It pulled ahead and it was outperforming semis. And then it just all reversed and that's over now. So this is an interesting thing to watch. So one of the things that I had thought as semis went up so quickly and so fast was that if there's a rotation, if the market stays healthy, risk appetite stays high, if there's a rotation, people won't want to exit technology, but they'll start looking for more attractively valued spots within technology. So there might be a rotation into software.
Well, software doesn't exactly fit that bill, relative to growth, and growth is slowing down and they're not particularly cheap just yet. You know what I mean? So I think you're going to see correlations go up. And I think the weak hands in a software, I think they sell off too. You know what I mean? And they might sell off badly, because Guy and I were talking about this the other day. We saw huge gaps lower in like Adobe and a handful of these other names, and then they went ServiceNow. They just filled in the gaps for no reason. So there were downside gaps after earnings and guidance about a month and a half ago. So again, I think people are going to be happy that they caught that trade on the low end. But when you think about the decelerating growth, and we had Guy, you missed this. It was really fun. Karen's husband, Lawrence Golub of Golub Capital, came on our show. The eponymous. Yeah,
that's a good
CNBC
word, by the way.
Fast Money. And we were talking a little bit about a third of their portfolio is enterprise software, and they bought a bunch of names in the private markets. Okay, so there's a private credit company, and they have the exposure, and they're starting to see a slightly slower growth rate in the private market. So I think you're likely to see that also in the public markets.
Yeah, I mean, I would be willing to bet, and we had that Taiwan semi chart up before. If you just look over that period of time, and this is just simple investor psychology, that was a longer term chart. I think it was about 5 years. That period of volatility, there are not a lot of investors that can hang on through that. So it looks like, okay, if I could just ride that out, look at the rise that I would have caught on the other
Mhm.
side. Find me somebody who's going to hold on from 2022 at that high all the way through 2020, early 2024, when it started to rise again. I think they lost a lot of investors there. And that is likely what would happen if we start to see a pullback in some of these names that have gone up so much, because number one, they're the easiest thing to sell, right? They're the easiest thing for most investors, both retail and professional investors, to unload. And if it goes on for a period of time and there's no clear recovery or new high in sight, I think people just get sick of it very quickly.
You have a bearish trade. I don't know if Amanda can pull up what I just sent her, because I threw a little eponymous at you and you looked at me quizzically like you've never heard the word before.
No.
But Amanda, if you can't put it up in a second. But Dan, before we do eponymous, let's talk about your trade.
Yeah, so let's look at the IGV. Amanda has the top 10 holdings here. The top 5 make up about 42%. The top 10 make up about 62%. You know the names. She'll throw them up there a little bit. And, we talked about the IGV yesterday, Guy, from a technical perspective here. So it stopped at that prior high going back to earlier this year. You see that gap. That's the gap that I'm talking about. When Salesforce was down like 20%, Guy, Adobe traded particularly poorly after that. ServiceNow, I mean, it kept on going, right? So obviously Microsoft is the third largest weight, and that stock has been making new highs, every day, it seems like, over the last month. But look at that move, filled in the gap and then got right back to the prior high. Now, if we want to kind of flash the SMH, look at what the SMH has done when it got back to its prior high. It's just blown out. And some of these big names, NVIDIA's up 100% in 6 months. Taiwan Semi is up 100% from the July levels a year ago, right? So you see what's going on here in the SMH once it broke out to new highs. So I look at the IGV. I don't want to touch semis right here, but I want to kind of get software going lower as we get into earnings season. I want to use options to do it. When the IGV today was trading about $86, you could buy the August 86.80 put spread, paying about $1.50 for that. You're buying one of the August 86 puts at around $2. You're selling one of the August 80s at 50 cents. So that is the 150 in premium that you're purchasing. It breaks even at 84.5. You have gains up to 4.5 between 84.5 and 80, with a max gain down at 80 or lower. Losses up to 150 between 84.50 and 86, with a max loss above 86. So really quickly, Guy, we're going to get to you in a second because I know what you're going to say. Okay, because you and I have been doing this a long time. This trade risks a little less than 2%, about 1.7% or so of the ETF, has a break even down 1.7%, and a max gain of 5% if the ETF is down 7% between now and on August expiration, which is obviously August, mid-August or something like that. So again, Guy, thoughts on the direction of the trade, the way I've structured it, maybe the technicals, whatever you want to say.
Well, if you look at, I like it because if you look at where we just topped out at, it's basically the same level we topped out at in terms of the IGV back in February, number one. So I think you're catching it at the right time. Maybe you missed it by a day, but that's insignificant, right? I think the level on the downside, I would change to sort of 77 or so, because that's the low that we saw, I want to say, in late May. And I think that's also the low that we saw in early June or so. So I would tweak my levels, and in fact, I would start to, and as you know, what I'd rather do is leg into it, because I think you're going to be right. So I'd leg into it by buying that put. Maybe 86 is a little aggressive, but it makes sense. I understand what you're saying. And then I'd wait for it to start to work for me. And then I'd sell a 77.5 or 78 put, which you'd probably get paid more for if it starts to work in a meaningful way. That's the only little tweak that I would make.
I just want to say something stylistically. So, I'm targeting 80. That's the 200-day moving average. It's also where those gaps were from late May based on those earnings, right? And so to me, I like to structure trades, where I can think about the risk reward, right? So I usually, on long premium directional trades, I'll risk about 50% of the premium that I'm spending. So in this case, it's about 75%. Now, sometimes these go away from you and you don't really have the chance to do that. But the last thing you want to do is have a bunch of long premium directional trades go to zero in your portfolio. So again, I like to structure, here's 86, about 0.25% of the range that I'm targeting. That makes sense to me. So I'll just leave it at that.
I like what you did. It's a nice trade. It's a stylistic
let's
thing.
see if it
By the way,
turns into a nice trade.
Do you have eponymous for me, Amanda? Because I sent it to her. If she has it, because then we have butters and then we have questions. So if you don't have it, just nod. Here it comes. Look at this.
I looked it up.
Eponymous.
Yeah.
is an adjective that refers to the person, place, or thing that something else is named for. By the way, REM had an album called eponymous. So it's a great word.
All
You
right,
can
leave
throw it
this
around.
up. I want to just
really
say
wanna
one
do
thing.
this?
So this is Google. No, this is really important. So we've been talking about what are these large language models doing, right? So she put eponymous in there. Okay, so she got a few images, but what it's done here, it's created a narrative rather than putting up a bunch of blue links if she wants to scroll. And so they finally got their act together with Gemini Advanced, and that's a lot more useful than that's what it used to look like. You used to have to click through, it'll have one or two comments above it, you know what I mean, that sort of thing. So again, Google, the alphabet, they finally got their act together.
So you're telling me this is the use case for AI?
I mean, it's pretty cool. It's
not
I don't
really.
think it's the use case.
Well, no, it's
it's
good for consumers. They run the risk of losing a lot of that AdSense revenue for people paying for, getting those blue links high on searches. You know what I mean? So that's the risk there.
Who do we love more than it besides Elizabeth? Who do we love more than
Butters.
I mean, I'm from Wisconsin. I like butter.
Yeah.
Butters.
We like butters in general.
So I'm not going to even say the word because apparently, you don't say words like that anymore. But please, Dan.
All right, let's do this here. So every week we get a preview of John Butters. He's the senior earnings insight analyst over there at FactSet. Look at that. You can have the earnings insight blog in your email. I think it drops on Friday mornings, but again, we get to look at it Thursday. So insight.factset.com/subscribe. I've been reading this thing for over 10 years, and Butters does great work. And I think the work is really important right now as we head into earnings season. So I just want to kind of focus on this one slide here first. And I want to get Liz's take on this. The S&P 500 is currently expected to report earnings growth of 8.4% for Q2 2024. The index will likely report actual earnings growth of at least 12%. So pretty well above what estimates are due to companies reporting positive EPS surprises. Over the past 10 years, 74% of S&P companies have beaten EPS estimates on average, with companies beating EPS estimates by 6.8% on average. As a result, the actual earnings growth rate has finished higher than the estimated earnings growth rate at the end of the quarter in 37 of the past 40 quarters, Liz.
Yeah, it's been pretty strong. And I don't think that this quarter is going to be any exception. I think that if there is weakness to come, it's not yet. And earnings season starting right now into a period where we're going to have this one Fed meeting, and then we've got a big long break in August aside from Jackson Hole. This will be another way, also GDP and growth data, that we can excuse or forgive any coolness in the labor market that might start to sound concerning. So I think earnings season is probably going to be fine. The only thing, as I know you guys have covered many times, are that revisions have not been downward as much as usual.
Yeah.
So it's possible that expectations are just a little lofty, but we've been saying that for many quarters and companies continue to beat them. The one thing I would say is, again, this is another process that takes a while. If growth is actually slowing and we continue to get below trend growth expectations and results, and if consumers do start to pull back, that will eventually feed into earnings. It is all connected. So at some point, margins will compress, or companies will have to get more creative about how they're managing their margins.
Let's go to some audience questions. And we have one that we've actually sort of mocked up in the form of Viking Therapeutics. And I think you were sitting next to me when we had this cat on the desk, but we talked to the CEO of Viking Therapeutics, and the stock was off to the races for a period of time. The good news is, if you're looking to enter it, it's pulled back a little bit. And the question suggested, have we filled the gap, and are we looking to sort of a good entry point? And the short answer is, I thought we had the question.
We do. They'll throw
it up. I mean, just don't leave me hanging here.
No,
but my point is, I think it is an actually interesting level to get in. Morgan Stanley initiated this stock. That's the last initiation that I saw was on June 27th, $105 price target. The range, according to FactSet, is anywhere from $90 to $138. You've gotten a pullback. You've filled in that gap to the upside, which I think is very encouraging. And you basically got down to the moving average as well. So I think this is as good a level as any. And I will say this, because we said it at the time, I thought you'd see a pullback. That was right. I also think this is going to be a target for a lot of companies. It's probably going to come in the form of $11 billion deal or so, which probably puts it right back to $100, Dan.
Yeah, I'll just say one thing about this. So I remember that conversation. I remember, again, at the time when you see a stock gap that way and just continue to go higher, people are chasing it. I don't know if there's a whole heck of a lot of short interest. You have to be crazy to short one of these kind of small cap biotech stocks. But, there's been a concerted sell-off here. What's going on? They had some data about GLP-1s, some of the weight loss drugs here. And again,
they're going to live in that space.
Yeah, so we know the frenzy in and around that. I'll just say the other thing is this company is actually pretty smart. They did an equity offering into that price action. I think they put close to $1 billion on their balance sheet. That should kind of give them, a bit of a lifeline if they get some bad data as it relates to some of the things that people got excited about in February.
As I've said a number of times, I know this gentleman was not named this by his parents
Wavy
at birth.
McFly.
See, you knew it.
Yeah.
You knew it. It's amazing because you pay attention. Cheapest thing you can do. Wavy asks, what's the most underappreciated sector of the market that you guys will think will benefit the most once money starts coming out of? I don't use the term, but you can see it there. Thank you. You want to take a stab at that, Elizabeth?
My stab would be if it starts to come out of the Meg 7. First of all, I think this happens in phases, but if it starts to come out of the Meg 7, I'll say it for you.
Thank you.
I'll say it multiple times.
Appreciate
so
it.
You don't have to.
Please.
Again, if it starts to come out of the Meg 7, I think that the trimming of gains will go into something cyclical because people are still positive about the economy. And I believe the beneficiary of that cyclical trade would be either energy or financials, perhaps both.
Dan?
All right, let's look at like industrials here. So if the economy is slowing a little bit, but then you have these rate cuts that are coming, right? Look at the XLI. This is an interesting one. So it never confirmed any of these new highs in the S&P 500. You see where that 200-day moving average is. I think a lot of these stocks that have acted weak relative to the S&P 500, I think they have another leg lower, despite at the 75% probability of a September rate cut here. So again, we don't even talk about China growth anymore. Do you remember like in 2022, that was supposed to be the thing that kind of saved the global economy? It never materialized. Obviously, we had a bad year in the S&P 500, and the way people were pricing things into 2023, they were basically pricing a recession. Never happened. So when you think about just some of the global weakness that we're seeing in other countries, I mentioned Deere before. These just don't interest. I'm hard pressed to find an industry that interests me. I would love to see what we had last summer when the S&P sold off 11% from the highs in July to lows in October. And you know where you buy the QQQ. I mean, because you have that exposure, but you want to see a 15% sell off versus an S&P, right? That's down 11%, or maybe something a bit greater, Guy.
Adam Beauregard.
There you go.
That's like French name. It's like a Bayou name.
Is Adam though?
Maybe, I don't know, but like when you see like OUX at the end of a name or that type of
way
thing.
Too many consonants.
Well, that's like a Louisiana thing. So he might be from Louisiana. Yeah. How do we know when to buy a stock when they're all rallying and falling on the same? We talked about that earlier.
Wait, they're all rallying and falling
on pretty much the same news. I mean, I don't know the answer to that. It's a fair question, but it seems like everything is moving on the same regurgitated piece of news to the upside, and I don't know how you sort of game that out. But I'll tell you, when it turns, the same thing's going to happen. And what we've learned over the years, things go down, Dan, faster than they go up.
Yeah, no doubt. What do they say? Escalator up, elevator
stairs
down.
Up.
Yeah,
because the stairs takes time.
Oh,
the escalator. I don't. By the way, and we're going to get out of here. I promise. You've traveled with me.
Yeah.
I don't use escalators.
You are brutal. No? He is brutal to travel with.
I walk up.
Are you afraid of them?
No, I'm not afraid of anything.
He meanders through the airport. He checks his bags. He's like thinks that TSA pre is a scam. You know what I mean? I don't even know.
But I walk up like the staircases.
Yeah,
I go
do
up,
but only for exercise.
Yeah, but usually,
that's why I do.
Usually, Guy, when we travel, we have somewhere to be.
Yeah, you always have somewhere to be.
You act, like on a schedule, and you act like you don't have a care in the world. The pilots love him when they see him in an airport. I don't know why. They all watch Fast Money, and they're like, you're the only guy that they recognize.
That's why he doesn't. He
Guy will be like, hey, this is
no, it's not why. I'm not looking. That's not why at all. But why do you need to rush? You know, it's funny. It's just everybody's run. This really frosts my what. In the old days, there was an arrow, and I promise, Amanda, there was People's Express. And that's how you used to get to Washington, D.C.
Okay.
And you didn't get a seat assignment.
Okay.
So you, by definition, you wanted to be one of the first assholes on the plane because you wanted to sit on either the aisle or the window, right?
Sure.
Makes sense.
Yeah.
Nowadays, unless you're flying that ridiculous airline, love Southwest Air, you get a seat assignment. They tell you where you're sitting.
Right.
So my question to you is, why do you have to rush? Like when that person gets on the microphone,
it's very simple.
Why is it
Yeah.
simple?
Because they're trying to race for overhead bin space.
Bang. And that's the other
Well,
thing.
if you don't have anything with you, if you don't have anything with you, you don't need it.
He wants to check that.
I like to check my bag too, just because it's a pain in the butt to worry about the overhead bin space.
I don't worry about anything.
And I don't want to have to do that thing at the end of the flight where everybody stands up at the same time and pulls their bag down, even though there's no room to pull your bag down.
Amanda's saying something on it. Thoughts? Oh, you know what? This is a company that I'm not all that familiar with, but Cuz Why Not is asking thoughts on Elf. Stock trades very
makeup company.
It's like, but they all trade expensive. It's like the one that Karen goes to.
Look at
what's
Estee Lauder. It trades horribly.
By the way, I believe Elf. I could be wrong about this. I believe ELF stands for eyes, lips, face. Just FYI.
Makes perfect sense.
Fun fact.
That's good. Let's pull up Ulta for a second.
That's the one.
Yeah, that's the one. Look at how poorly that trades. Then we could pull up Estee Lauder. That would be EL. Does that stand for eyes and lips?
I think E in Estee Lauder is something that Tim Seymour's.
Look at this one. It's making new 52-week lows. It's disgusting. Well, I think what we're seeing here is kind of important, and we've been talking about this. Pull up Dollar General for a second, guy. That's a name that you kind of been all over. We're seeing two economies here, and I don't know if the makeup companies, fit into that. I mean, Ulta is a very different brand than, let's say, Sephora, right? Like Ulta is a much lower end sort of one.
It's gotten less
but you're seeing a trade down here, and I mean that's just a matter of fact.
That's where I go to get my St. Ives facial scrub.
Yeah, often. I mean, look, as somebody who actually buys makeup and shops at all of the makeup places, I own an ELF brush. I went to Ulta this past weekend. I went to Sephora today. There is a little bit of a difference, but I will say those stores, at least Sephora stores in the city, always busy, always a line to check out.
People want to look good.
It's happening. I think it'll take a while for that to come down. Now it does get expensive, but think about just the little things that you're buying at one time. You buy one item, maybe it's $28. It's not like you're going to walk out of there feeling guilty about $28. You go into Home Depot, you buy a washer and dryer, you walk out of there $5,000 poorer and feel a little bad about it.
That's what do you call that? Disposable goods, and the other one is durable goods.
Yeah,
durable, because and washer should be durable.
Yeah.
Correct.
You'd like to own that sucker for like a decade.
You hope so.
If you take care of it.
Yeah.
You know what you don't,
take care of a washer.
You don't slam the friggin' door like a lot of people do.
Okay.
You're gentle with it. You understand?
You don't overstuff it.
You don't overstuff it. You
Yeah.
clean the filter every once in a while. No?
I don't even know where that is, but yeah.
It's down below. There's like
Greg,
a little.
are you listening?
All right.
Can you make sure we clean the
not
washer
listening.
filter?
All right. Well, look, that's it. It's almost an hour, and you got places to be, and you're hot.
I got to get there sweating. Yes.
But I enjoyed this. Tomorrow, I think the two of us, Carter Braxtonworth, will be back with us. So I hope people stuck around. We got to talk about damn Yankees.
Yep.
We mentioned eponymous. Nobody had that shit on their bingo card.
Nope.
And that's it. Dan's got a nice haircut.
I do.
And Swizzle's about to just say, see you later, people.
See you later, everyone. Thanks for being here, Liz.
Bye, guys.
All right. See you.